They are loading the weapon. Right now, as you watch this video, as the silver price pushes higher, as the shorts sweat through their designer suits, as the physical market screams for more metal, there's a group of people in Chicago preparing to do what they have done every single time silver threatens to break free. They are preparing to flip the switch. The CME group, the privately owned company that controls the COMEX futures exchange, has a button, a nuclear button. And every time silver starts running, every time retail investors start winning, every time the paper manipulation starts failing, they push that button. They raise margin requirements. And when they do, the rally freezes, the momentum dies, the longs get liquidated, and the banks, the shorts, the manipulators, they get bailed out once again. This has happened in 1980, this happened in 2011, this happened in 2021, and the evidence is mounting that they are about to do it again. Today, we are going to expose the margin manipulation playbook. We are going to show you exactly how they use this weapon. We are going to reveal the specific triggers that tell you when the switch is about to flip. And most importantly, we are going to show you how to position yourself so that when they freeze silver at the worst possible time, you are on the right side of history. This is finance monopoly. And this is the information they absolutely do not want you to have. Let's begin. For those of you who have been in this fight for years, you already know the pattern. You have lived through the heartbreak. You have watched silver rally to the edge of a breakout, only to see it smashed back down in a matter of hours. You have asked yourself, how is this possible? How can a market move so violently against all fundamentals? Now you know the answer. It was never a free market. It was never supply and demand. It was a rigged casino where the house changes the rules every time you start winning. We are the ones who refuse to accept the official narrative. We are the ones who dug into the QOT reports, the bank participation reports, the margin requirement history. We are the ones who connected the dots that the mainstream financial media refuses to connect. And we are the ones who are going to win. Because here's the thing about the margin manipulation weapon. It only works if people don't understand it. It only works if investors panic when the switch flips. It only works if the longs capitulate and hand their positions to the shorts at the worst possible moment. But once you understand the playbook, once you see the pattern, once you know exactly what they are going to do before they do it, the weapon loses its power. Today, I'm going to give you that understanding. I'm going to make you immune to the margin manipulation. I'm going to show you how to not just survive the next margin hike, but to profit from it. This is the knowledge that separates the stackers who hold through the storm from the speculators who get washed out. Pay attention. Before we can understand how they use margin as a weapon, we need to understand what margin actually is, because the CME counts on the fact that most investors don't understand this mechanism. They count on confusion. They count on complexity. They count on you being too intimidated to look behind the curtain. So let me make this crystal clear. When you trade futures contracts on the COMEX, you don't pay the full value of the silver up front. If you buy a single silver futures contract representing 5,000 ounces, think of it as a good faith deposit. It is collateral that ensures you can cover potential losses on your position. There are two types of margin. Initial margin is what you need to open a position. Maintenance margin is the minimum you need to keep the position open. If your account falls below the maintenance margin because the trade moves against you, you get a margin call. You must deposit more money immediately or your position gets liquidated. Now here's where it gets interesting. The CME sets these margin requirements. They can change them whenever they want. They claim these changes are based on volatility and risk management. They claim it is all very technical and objective. But the historical record tells a very different story. Let me give you the numbers. Let me show you exactly how they have weaponized this system. In 2011, silver was on an epic run. It had broken through $40 and was racing toward $50. The shorts were bleeding. The banks were facing billions in losses. The entire paper manipulation scheme was about to be exposed. And then the CME acted. Between April 25th and May 5th, 2011, the CME raised silver margins 5 times in 9 trading days. 5 times. What happened to silver? It crashed from $49 to $34 in a matter of days. A 30% collapse. Billions of dollars in long positions were liquidated. The rally was murdered in cold blood. And who benefited? The shorts, the banks, the same entities who had been losing money every day. Silver went higher, suddenly saw their positions swing back into profit as leveraged longs were forced to sell. This is not conspiracy theory. These are publicly available facts. The CME's own records show the margin increases. The price charts show the crashes. The only thing that is not admitted is the intent. But when you see the same pattern repeat over and over again, intent becomes obvious. Let me show you another example. February 2021, the silver squeeze movement. Retail investors coordinated to buy physical silver in PSLV to drain the COMEX. Silver broke above $30 and was accelerating. The CME raised margins by 18% overnight, from approximately $14,000 to $1,600 per contract. The rally stalled, the momentum broke. Silver peaked and began a long decline that lasted for months. Coincidence? Once is happenstance. Twice is coincidence. But we have documented over a dozen instances of margin increases at critical technical moments in silver's history. That is not coincidence. That is policy. That is the playbook. Now, let me walk you through exactly how a margin increase kills a rally. Because when you understand the mechanics, you understand why this weapon is so devastatingly effective. Imagine you are a speculative trader. You believe silver is going higher, so you go long. You have $50,000 in your account. The margin requirement is $10,000 per contract. So you can control 5 contracts, representing 25,000 ounces of silver. Silver is at $30 per ounce. Your position is worth $800,000, but you only have $50,000 at risk. This is the power of leverage. Every $1 move in silver equals a $25,000 profit or loss for you. Silver rallies to $35. You're up $75,000. You feel like a genius. You might even add another contract with your profits. But then the CME announces a margin increase. The new initial margin is $16,000 per contract. Your 5 contracts now require $80,000 in margin, but you only have $50,000 plus your unrealized gains. Even worse, the announcement itself creates fear. Other traders know what's coming. They start selling to reduce their exposure. The price starts falling. Now your unrealized gains are shrinking. As the price drops, you go from $75,000 in profit to $50,000, then $25,000. Then you are back to break even, and you still don't have enough margin to hold your full position. Your broker issues a margin call. You have 24 hours to deposit more funds, or they will liquidate your position. But you don't have more funds. You are already all in. So your broker starts selling your contracts into a falling market. You are now a forced seller. You are adding to the selling pressure. You are part of the cascade, and you are not alone. Thousands of traders are in the same position, all getting margin calls at the same time, all being forced to sell at the same time, all dumping their positions into a market that cannot absorb the volume. This is the liquidation cascade. This is the weapon. The price doesn't fall because the fundamentals changed. The price doesn't fall because there is more silver available. The price falls because the rules of the game were changed in the middle of the trade. And who is on the other side of this trade? Who is buying what the longs are forced to sell? The banks, the shorts, the entities who knew the margin hike was coming, the entities who may have even requested the margin hike. This is wealth transfer by regulatory fiat. This is legalized theft. This is the game. Now let me show you why the current situation makes another margin attack almost certain. Every time the CME has deployed the margin weapon, there have been specific conditions present, a specific setup that tells you the switch is being loaded. And right now, every single one of those conditions is flashing red. Condition 1, price acceleration. The CME claims that margin increases are responses to volatility. When the price moves faster, they say, the risk increases, so margin must increase. But notice the asymmetry. They raise margins when silver is rising fast. They rarely raise margins when silver is falling fast. The volatility argument only applies in one direction. Upward volatility is dangerous. Downward volatility is apparently fine. Right now, silver has been accelerating. We have seen strong rallies. We have seen increasing momentum. We have seen the kind of price action that historically triggers the CME's intervention. Condition 2, short position pain. The bank participation report and the commitment of traders report show us the positioning of the major players. And right now, the commercial traders, the bullion banks, are sitting on massive short positions. The latest data shows that the 4 largest traders are short over 45,000 contracts. That is 225 million ounces of paper silver. Every dollar that silver rises costs them $225 million in mark-to-market losses. At current price levels, these short positions are deeply underwater. The banks are bleeding. And when the banks bleed, the CME tends to find reasons to help them stop the bleeding. Condition 3, retail participation surge. The CME and its member banks despise retail participation in the silver market. When retail traders pile in, they add buying pressure that is not coordinated with the banks. They are unpredictable. They are not part of the club. And right now, retail participation is surging. The silver squeeze movement never really died. The Reddit forums are active. The stacking community is growing. Physical demand from small investors is at record levels. The CME sees this. They see the order flow. They see the new account openings. They see the social media sentiment. And they know that if they do not act, this retail wave could overwhelm their defenses. Condition 4, open interest expansion. Open interest is the total number of outstanding futures contracts. When open interest is rising alongside price, it means new money is entering the market to go long. This is the most bullish configuration. And right now, open interest in silver futures has been expanding. New longs are entering. The commitment to higher prices is growing. The shorts are not being covered. They are being overwhelmed by new buying. This is exactly the setup that preceded the 2011 crash. This is exactly the setup that preceded the 2021 intervention. Rising price, trapped shorts, retail enthusiasm, expanding open interest. The switch is loading. The only question is when they flip it. Let me walk you through the historical record in detail, because the pattern is so consistent, so predictable, that once you see it, you can almost predict the interventions to the day. The Hunt brothers, Nelson Bunker Hunt and William Herbert Hunt, attempted to corner the silver market. They accumulated physical silver and silver futures, driving the price from $6 to nearly $50 per ounce. The banks were short. The banks were getting destroyed. What did the authorities do? On January 21st, 1980, the COMEX changed the rules. They announced Silver Rule 7, which prohibited new long positions in silver. You could only trade to liquidate existing positions. If you were short, you could stay short or cover. If you were long, you could only sell. Think about the asymmetry. Think about the blatant favoritism. They did not freeze the market. They froze only one side of the market, the side that was winning. Simultaneously, they raised margins to 100% of contract value for certain traders. You had to pay full price, eliminating all leverage. The cost to maintain long positions became prohibitive. Silver crashed from $50 to $10 over the following months. The Hunt brothers were bankrupted. The banks were saved. This is not ancient history. This is the template, the mini squeeze. Silver ran from $9 to $15. Margins were increased multiple times. The rally stalled and silver pulled back 30%. The pre-crisis run. Silver approached $21. Margins were hiked. Silver crashed to $9 during the financial crisis. The paper price was smashed even as physical demand exploded. The Great Silver Massacre. We already covered this, but let me add detail. The 5 margin hikes in 9 days were not random. They were calibrated to hit specific levels. The first hike was 13%. The second was 10%. The third was 9%. The fourth was 10%. The fifth was 84% cumulative from the start. Each hike was announced after market close, giving traders no time to adjust during trading hours. By the time the market opened, the damage was already being calculated. Margin calls were already being issued. The timing was surgical. The silver price was at $48.70 when the hikes began. It never recovered to that level. To this day, 14 years later, silver has not returned to its 2011 high. That is the power of the margin weapon. The Reddit rebellion. When the Wall Street bets and silver squeeze communities started buying, the CME acted preemptively. They raised margins before silver could break $30 convincingly. This time the message was clear. We know what you're trying to do, and we will not allow it. And now, here we are again. Silver is running, the shorts are trapped, the retail community is active, the physical market is tight. The historical pattern says an intervention is coming. The only question is whether you will be prepared. Now, I need to tell you something that will make you angry, something that reveals the true nature of this system. The CME Group is not a neutral regulator. The CME Group is not a government agency. The CME Group is a publicly traded, for-profit corporation. Its ticker symbol is CME. You can look it up. You can see who owns it. And who owns it? The banks, the hedge funds. The same entities that hold short positions in silver futures are major shareholders in the company that sets the margin requirements. JP Morgan is a CME clearing member and has been accused of silver manipulation in multiple lawsuits, including cases they paid hundreds of millions to settle. Goldman Sachs is a major player. Citadel is involved. The entire network of financial institutions that benefit from suppressed silver prices has direct relationships with the CME. This is like allowing the New England Patriots to also own the NFL and write the rules of the game while they are playing, and it gets worse. The CME has something called the Risk Committee. This committee advises on margin requirements. And guess who sits on this committee? Representatives from the member banks. The shorts are literally in the room when decisions are made about margin policy. They will tell you it's all about risk management. They will tell you the algorithms and models determine margin requirements objectively. But the historical record proves otherwise. If margin changes were purely objective, purely based on volatility metrics, we would see symmetric responses. Rising volatility when silver crashes would trigger margin increases just as quickly as rising volatility when silver rallies. But we don't see that. We see margin increases overwhelmingly clustered around silver rallies. We see margin increases that coincidentally arrive at the exact moment the shorts need relief. We see a pattern that defies statistical probability if the system were truly neutral. In 2020, when silver crashed from $18 to $12 in the pandemic panic, did the CME raise margins on the shorts to manage volatility? No, margins were actually reduced in March 2020, making it cheaper to short silver during the crash. The asymmetry is undeniable. The game is rigged, and they don't even hide it very well because they know nobody's watching, but we are watching. Finance monopoly is watching. And we are going to make sure you understand exactly what is happening. Let me give you the specific numbers that tell me the switch is being loaded right now. Current initial margin for silver futures is approximately $15,000 per contract. Maintenance margin is approximately $13,500. These levels were set during a period of lower volatility. As silver has rallied and daily price swings have increased, the CME's own volatility models would justify margin increases. Based on my analysis of historical patterns, here's what I expect. When silver approaches key psychological resistance, likely between $35 and $40 in the current environment, the probability of a margin increase rises dramatically. The first hike will probably be in the range of 15% to 20%. Enough to cause pain, but not enough to cause outrage. They will frame it as routine risk management. If that doesn't stop the rally, expect a second hike within days. This one will be larger, perhaps 20% to 25%. If silver continues advancing despite the margin hikes, they will escalate. Multiple hikes in rapid succession, just like 2011. The goal is not to stop silver from ever rising. The goal is to control the pace. The goal is to allow the shorts to cover at lower prices. The goal is to prevent a disorderly squeeze that would expose the entire paper manipulation scheme. And here is the critical insight. The margin hikes are most effective when they catch people off guard, when traders wake up to unexpected margin calls, when the announcement comes after hours and there is no time to react. But if you know it's coming, you can prepare. If you know the playbook, you can position yourself accordingly. Here is what I am watching for as specific triggers. Trigger 1. Daily price moves exceeding 5%. When silver starts moving 5% or more in a single session, the volatility excuse becomes available. The CME will have cover for their action. Trigger 2. Open interest hitting new highs. When open interest expands rapidly, it means new leveraged longs are entering. And these are the targets. These are the traders who will be margin called. Trigger 3. Mainstream media coverage. When CNBC starts talking about silver, when Reddit makes headlines again, when retail participation becomes visible, the CME knows it is time to act. Trigger 4. Bank participation report showing increased short pain. When the next BPR shows the big banks with larger losses, the intervention becomes more likely. Watch these indicators. They are your early warning system. Now, let me tell you something that will change how you think about this entire situation. The margin weapon only works in the paper market. It only works against leveraged speculators. It only works against traders who can receive margin calls. It does not work against physical holders. If you own silver in your hand, in your safe, in your vault, the CME cannot margin call you. They cannot force you to sell. They cannot liquidate your position. They cannot change the rules on you. This is the ultimate defense against manipulation. This is why we preach physical ownership on this channel. This is why we tell you over and over again that the only silver that counts is the silver you can touch. When the CME flips the switch, when the margin calls go out, when the paper price crashes, what happens to your physical silver? Nothing. It sits in your safe, completely unaffected by the chaos in the paper market. And here's the beautiful part. While the paper price crashes, the physical market often diverges in the opposite direction. We saw this in 2020. The paper price crashed to $12. Could you buy physical silver for $12? Absolutely not. The premiums exploded. The real price was $25 to $30. We saw it in 2021. The paper price pulled back. But physical premiums stayed elevated. Dealer inventories stayed tight. The margin weapon destroys paper longs, but it often exposes the disconnect between paper and physical. It often creates the best buying opportunities of the cycle. So if you are holding physical silver and the CME announces a margin hike and the paper price crashes, what should you do? You should buy more. You should take advantage of the artificial discount created by the manipulation. You should be the one scooping up metal while the leveraged speculators are being forced out. This is how you turn their weapon against them. This is how you win a rigged game. And there is another layer to this immunity. The more silver that moves from paper markets to physical hands, the less metal is available for the COMEX to deliver. The more stackers accumulate, the tighter the physical market becomes. The tighter the physical market becomes, the harder it is for the banks to maintain the illusion. Every ounce you buy is a vote against manipulation. Every ounce you hold is a withdrawal from their fractional reserve system. Every ounce that moves from paper to physical brings us one step closer to the day when the margin weapon no longer matters because the paper market has lost all credibility. This is the strategy. This is how we win. Not by playing their game on their terms with their rules that they can change at any moment, but by opting out of their game entirely, by moving to physical, by becoming unmargin callable. But here's the thing they don't want you to know. The margin weapon is losing its effectiveness. Each time they use it, more people wake up. Each time they manipulate the price, more investors move from paper to physical. Each time they flip the switch, the physical market gets tighter and the divergence gets more obvious. In 1980, the margin manipulation worked because almost nobody understood what was happening. The information was not available. The internet did not exist. The Hunt brothers were painted as villains, and most people believed the official story. In 2011, it still worked, but cracks were showing. The silver community was more organized. The manipulation was documented in real time. People started asking questions. In 2021, the effectiveness was diminished. Despite the margin hike, the physical market remained tight. Premiums stayed elevated. The silver community did not fully capitulate. Many held through the pain. And now? Now there are millions of people who understand the game. Now there are channels like Finance Monopoly explaining exactly what is happening. Now there are communities that share information instantaneously. Now there are stackers who have been through this before and know the playbook. The margin weapon works through fear and confusion. But we are no longer afraid. We are no longer confused. We know exactly what they are doing and why. And there is a more fundamental problem for the manipulators. The physical supply is genuinely running out. They can manipulate the paper price all they want. They can raise margins to 100%. They can ban trading entirely like they did in 1980, but they cannot create more silver. They cannot print physical bars. They cannot conjure ore deposits into existence. They cannot speed up geology. The industrial demand is exploding. The solar industry consumes more silver every year. The electronic vehicle transition requires massive amounts of silver. The 5G rollout uses silver. Medical applications use silver. Military applications use silver. This demand is not speculative. It is not based on price. It is structural. These industries need silver to function. And while demand grows, supply stagnates. Mine production is flat to declining. The cost to extract silver is rising. New deposits are not being discovered at rates sufficient to replace depleting mines. The margin manipulation might freeze the paper price, but it cannot freeze the physical deficit. It cannot stop the drawdown of above-ground inventories. It cannot prevent the eventual reconciliation between the paper fiction and the physical reality. Every manipulation is now buying time, not solving the problem. Every intervention delays the inevitable, but makes the eventual resolution more violent. The spring is being compressed, the pressure is building, and when it finally releases, no amount of margin manipulation will be able to contain it. So how do you play this? How do you position yourself for the manipulation you know is coming, while also positioning for the ultimate resolution you know is inevitable? Here is the Finance Monopoly strategy framework. First, minimize or eliminate leveraged paper exposure. If you're trading silver futures, understand that you are playing in a rigged casino. The house can change the rules at any moment. You can be right about the direction and still lose money because the CME decided to margin call you out of your position. If you insist on trading futures, use minimal leverage. Keep substantial cash reserves to meet margin calls. Assume that margins will be raised at the worst possible moment and plan accordingly. Better yet, if you want paper exposure, use options instead of futures. When you buy a call option, your maximum loss is the premium you paid. You cannot be margin called. You cannot be forced out of your position. Yes, you can lose 100% of your premium, but you cannot lose more than that. Second, prioritize physical accumulation. This is the core strategy, the foundation, the position that cannot be margin called. Buy physical silver consistently. Do not try to time the bottom. Do not wait for the manipulation-induced dips. Cost average over time. Focus on products with the lowest premiums relative to their liquidity. Bars over coins if you are purely focused on ounces. Generic rounds over government-minted coins if premium is your priority. But also recognize that in a supply crisis, any silver is better than no silver. If the only product available has a high premium, pay the premium. Availability matters more than optimization. Third, understand the manipulation calendar. Margin changes typically come after market hours. They often come on Fridays to maximize the weekend anxiety. They often coincide with monthly options, expiration, or first notice day on futures contracts. Be aware of these timing patterns. If you are holding leveraged positions, reduce exposure going into these risk windows. Also watch for coordinated efforts. Margin increases often coincide with heavy paper shorting, negative analyst reports, and mainstream media hit pieces. They attack on multiple fronts simultaneously. When you see this coordination, recognize it as a sign that they are worried, not a sign that you should sell. Fourth, use manipulation events as buying opportunities. When the CME hikes margins and the paper price drops, the physical market often offers bargains. Premiums may temporarily compress as dealers try to attract buyers during the panic. Have cash reserves specifically allocated for these moments. When others are panicking, be greedy. When the manipulation creates artificial sale prices on physical metal, take advantage. Fifth, maintain a long-term perspective. The manipulators want you to focus on the daily chart. They want you to feel every tick. They want you to agonize over every pullback. Zoom out. Look at the monthly chart. Look at the yearly chart. Look at the decade chart. Silver has been in a long-term uptrend despite all the manipulation. Every intervention has created a temporary pullback that was eventually overcome. The lows keep getting higher, the walls keep getting breached. The manipulation can win battles, it cannot win the war, and when you have a long-term perspective, the battles matter less. Let me tell you what I see coming. Not tomorrow, not next week, but over the next cycle. The CME will flip the switch again. This is almost certain. They will raise margins. They will crash the paper price. They will margin call thousands of leveraged longs. Headlines will declare the silver rally dead. And then something different will happen. This time, the physical market will not capitulate. This time, the stackers will not sell. This time, the industrial users will not stop buying. This time, the Chinese and Indian and Russian buyers will not retreat. The paper price will drop, but the physical price will hold. The premiums will explode to levels never seen before. The divergence will become so obvious that even the mainstream media cannot ignore it. And then the questions will start. Why is the spot price showing $28 when you cannot buy an ounce for less than $45? Why is the COMEX price different from the Shanghai price? Why are dealers sold out if the price is falling? These questions will undermine confidence in the paper market. These questions will drive more investors from paper to physical. These questions will accelerate the very trend the manipulation is trying to prevent. And at some point, there will be a delivery failure. Someone will stand for delivery and the metal will not be there. The COMEX will offer cash settlement at a premium, and the buyer will refuse. The failure will become public. When that happens, the paper market loses all credibility instantly. The price discovery function shifts entirely to the physical market. And the physical market, where supply is genuinely scarce and demand is genuinely strong, will reprice silver to its true value. That value is not 30. That value is not 50. Based on the monetary inflation of the last decade, based on the industrial demand profile, based on the supply constraints, the true value of silver in a free market is likely over $100. And when the paper cage finally breaks, the move to that true value will not be gradual. It will be violent. It will be fast. It will leave behind everyone who was waiting for confirmation. The margin manipulation is not a reason to avoid silver. The margin manipulation is a reason to buy physical silver as fast as you can before the paper game ends entirely. Here is my warning to you. The next margin attack is coming. If you're leveraged long in the paper market, you're in the crosshairs. They will come for you. They will margin call you out of your position at the worst possible moment. They will take your money and give it to the shorts. Do not let them. Reduce your leverage now, not when the attack comes, because by then it is too late. Now. Convert paper exposure to physical exposure. Move from the rigged casino to the real market. Take possession of the metal that they cannot margin call away. If you insist on paper exposure, use products they cannot manipulate as easily. PSLV holds allocated physical silver in Canadian vaults. It is not perfect, but it is better than unallocated paper or futures contracts. Prepare mentally for the volatility. When the switch flips, when the price drops, when the headlines scream that silver is crashing, you need to be ready. You need to have the conviction to hold, or better yet, to buy. The manipulation is a test. It separates the weak hands from the strong hands. It separates the tourists from the true believers. It separates those who understand from those who are just along for the ride. Pass the test. Hold through the pain. Buy the dip they create. And know that every manipulation brings us closer to the end. Every intervention delays the reckoning but makes it more severe. Every switch flip is a sign of desperation, not strength. They flip the switch because they are losing. They flip the switch because they have no other choice. They flip the switch because the fundamentals are against them and manipulation is their only weapon. But weapons run out of ammunition. And when the margin manipulation finally fails to produce the desired result, they will have nothing left. This is finance monopoly. We do not hide from the manipulation. We expose it. We understand it. We profit from it. They have flipped the switch before. They will flip it again. But we know the playbook now. We know exactly what they will do and why. We know how to position ourselves on the right side of their manipulation. Physical silver cannot be margin called. Physical silver cannot be paper shorted. Physical silver cannot be taken from you by a rule change in Chicago. When they flip the switch, we will be ready. When they crash the paper price, we will be buying. When they think they have won, we will be stacking. The CME has a button, but we have something more powerful. We have the truth, we have the fundamentals, we have the metal. And when the paper game ends, when the margin manipulation finally fails, when the physical market takes over price discovery, we will be the ones left standing. They can freeze the paper price. They cannot freeze reality. The switch is loading. Let them flip it. We are ready. Stack, hold, win. If this video opened your eyes, if you finally understand the margin manipulation game, hit that subscribe button. Turn on notifications. Because when the switch flips, we will be here with real-time analysis and strategy. Share this video with someone who is leveraged long in paper silver. They need to hear this before the margin call comes. Drop a comment below. Tell me your strategy for surviving the next margin attack. Tell me how much of your position is physical versus paper. Let's build a community that is immune to manipulation. The next attack could come any day, but now you're prepared. Now you understand. Now you know exactly what they are going to do and exactly how to profit from it. This is Finance Monopoly. We expose the game. We teach the strategy. We build generational wealth while the manipulators build their own doom. Stay vigilant, stay stacked, stay ready. I'll see you in the next one.